So looking ahead to the week starting October 7th, we do have some big economic events happening and political as well. So there's the Eurogroup meeting taking place. There's also the release of the Federal Reserve minutes. Of course, it's a meeting in which they cut interest rates, so that will be heavily watched. But this week also comes on the back of a week of heavy declines across equity markets. So clearly trading, at least at the start of the week, will be in the context of whether those declines will continue. So we did have a rough start to October. It was really led by the US. We saw the S&P 500 and the Dow see sizable declines in the region of 2% for a couple of days running. And it was one of the sets of declines was related to a big monthly decline in manufacturing data. In fact, it was the worst set of manufacturing data for the US in a decade. So clearly exacerbating fears about a slowdown in the US and thus globally. And so equity markets fell in suit. But it wasn't all down to that one data release. It's just a concept that the markets are grappling with at the moment is how bad does this economic downturn get and how are central banks going to react to it? And there is a little bit of concern about what the Fed will do, hence the interest in those FOMC minutes this week. For FX markets, the dollar was a loser from that US manufacturing data. It saw some declines pulling off close to multi-year highs. Oil also trading in the context of a kind of growth downturn environment. So oil declining way below those Saudi drone strike levels, and gold, of course, a beneficiary of that US dollar weakness. Fed minutes will be most widely watched in the economic calendar this week, but it could be US CPI data released later in the week that gives markets the best indication of what the Fed's short-term move in interest rates will be. The logic being that while CPI is in the region of 1 to 2%, the Fed can probably do what they want in terms of interest rates, but clearly a drop in inflation data does support another rate cut coming in October. Should we see inflation tick up a bit with other data in the US, broadly okay, obviously with the exception of that manufacturing data, then it makes it a little bit trickier for the Fed to raise rates in that environment. Another monthly decline in Germany factory orders could put a lid on that recent euro strength / dollar weakness that we've been seeing, just acting as a reminder that Europe remains in a much more fragile economic position than the US. So getting back onto the discussion of trade talks, it had been a source of optimism since the start of September, and you could actually argue that most of September's gains were due to markets feeling good about these set of trade talks announced between the US and China scheduled for this coming week. But as we currently find ourselves, the US indices, including the S&P 500, now probing 30-day lows. So in fact, we've unwound almost all of that optimism towards these trade talks. For our part, at least, the expectations about how these trade talks work out has probably not changed, i.e. we're not really expecting anything too massive to happen, particularly before the US election even. We just want to see the US and China still talking. That opens up a future pathway to a deal. But because of the more negative environment around these talks, namely the Federal Reserve still acting a bit cautiously towards its rate cuts, some quite drastic moves in bond markets, we've just seen a downturn in economic data generally. More recently, we've seen that the US announce more tariffs or a new round of tariffs against Europe. So in that difficult backdrop, actually, it would be very helpful for markets to see some sort of positive resolution from this meeting. A deal at this stage seems very unlikely, but if there were some sort of concessions, particularly on the US side, for example, rolling back some of those tariffs against China, that would be seen very constructively and could actually unwind the negativity that we currently find ourselves in markets, hence the importance of these trade talks. I wanted to touch on the Fed minutes briefly as well, even though they are somewhat out of date now, in that the Fed was obviously making its decision about its September interest rate cut without the knowledge of the worst data that we've now found ourselves with, particularly this 10-year low in manufacturing that I mentioned. So to a large extent, the framework with which the Fed were working in that meeting is out of date. Nonetheless, I think we can get a feeling for what is probably the most important overall sense about where the Fed are going next is how many of the members of the Fed think that the current rate cutting that the Fed is doing is just a temporary mid-cycle adjustment, and how many are starting to realign themselves to the idea that this is actually a more sustained rate cut cycle. If there is any evidence that other members are starting to see this more as a rate cut cycle with more interest rates to come, it becomes more in line with markets, and I think we'd see an improvement in risk sentiment. But again, that's peppered with the fact these minutes are slightly out of date. Okay, worth mentioning that these recent declines in markets have happened in October and at the start of the fourth quarter. So at the beginning of the quarter, you normally have some quarterly adjustments in big work with big fund managers. October is known to be a historically difficult time for the market when we've seen some of the most dramatic historical declines. Nonetheless, I think it's important not to read too much from just a couple of days worth of price data across the whole month. If news improves, then we can still see positive returns for October, despite the difficult start that we've had so far. But I think it's important to take something away from this, and that's that we're coming towards the end of a year where there has actually been quite a few geopolitical issues out there that haven't been completely addressed yet, and actually more keep reappearing. The sanctions on Europe, the impeachment of Donald Trump, the proceedings of at least. New things are occurring, but they're not addressed. There is added uncertainty out there. So if you're seeing returns in your portfolio at the beginning of the fourth quarter, clearly there's going to be some temptation to sell out of some of your portfolio and take some money off the table. So that self-fulfilling prophecy in many ways could actually exacerbate any declines that we see this month, but it won't just be because we've seen 2 days of declines. Right, thank you very much for watching, and of course if you do enjoy these videos, make sure to follow myself and LCG on YouTube and social media.